surround yourself with a few very good advisors that have been through the journey, and trust their their opinion, and try to listen to them properly and actually benefit from that experience.
Hadi, welcome to the Seat of the Muse podcast.
Thank you. It's very good to be here.
Great to have you. So today I want to talk about sports and your whole journey, because most of us experience sports, from the sidelines. We go watch a game, we support a team that we love, but we rarely think about what sits behind it and the business, of sport, and looking at it as an asset class. And that's something that's been growing massively. The global sports market today is estimated to be worth well over $500 billion, with some of the biggest clubs, generating hundreds of millions in annual revenues. Yet for most people, investing feels like it's out of reach, and it's reserved for, a select type of people. So you co-founded Stryde, an investment platform built around opening access to a world that most people never get to step into. So today I want to talk about, this intersection of yours between finance, entrepreneurship, accessibility, and your journey into building Stryde, and how does one look at sports as an asset class and an investment. So let's start at the beginning. You came from an investment banking background. It's very structured, high-pressured environment. What was the moment for you when you realized that entrepreneurship was pulling you more strongly than, staying in this path?
First of all, thanks for that great introduction. And I think it started long before investment banking. When I moved to study in London, I came across a platform that allows people to invest in startups. And then I was there sitting, investing £50 on £100 in companies all over the world that are creating something new. And I just loved the idea. And I thought the concept is brilliant. It's innovative. And then after that, I moved to Dubai in 2020, and I started looking at the region. It's a place where there's disposable income, there is good purchasing power, but there isn't actually a platform that allows people to invest in private markets. So that was the initial thesis. That's how I wanted to start. But then I was, getting this corporate experience, the safety of it, and I had the first job. Then I moved to another job, which was more in mergers and acquisitions, and I kind of just, let this idea grow slowly. But there was a certain point in time, and it was the summer of 2022, when I decided that this is the time. I'm going to take the next 6 months to put everything together, and within 6 months, I have to quit my job and do this. I was just so passionate about it. I saw the potential of it, and I also wanted on a personal level to see what's the limit. In a job, there is a ceiling.
Yeah.
However high you can go, however much you can do, there is a ceiling. And I wanted to see what I'm capable of doing on my own. And this was the idea I was so passionate about, and I believed in it. So that's how we started. And the initial thesis was private markets. We can get into how we ended up being into a sports business later on.
Yeah. And so you kind of are trying to democratize private markets. Can you explain a bit kind of what that means for people who don't really know?
Yeah, so today you've got what we call public markets, which is the stock market. And there's so many service providers, applications, platforms where you can go on and buy an Apple stock or a Tesla stock. And that's been around for a while. And you can put $10, $50, $100. To a certain extent, similarly with real estate. And we've seen that real estate, let's say crowdfunding or tokenization has been a theme over the past 5 years. But in companies that are not publicly listed, and that could be from the early stage startup to a pre-IPO company like OpenAI and SpaceX, you don't really have access. And that's what we wanted to create. We wanted to create the opportunity for individuals to invest small tickets into companies that are privately held, companies that are not public listed, that people don't have access to. But then also from a financial perspective, that's where the returns are. A company can make 10x or 100x when it's private. On the stock market, might, but it's not really the returns that you look at. So it's a different risk-reward profile, different asset class, and we just wanted to open up venture capital and private equity for everyone to invest.
Okay, amazing. And so you said it took you give yourself 6 months.
Yeah.
Were you starting working on that platform and that idea on the side, or did you actually quit and give yourself, 6 months and then
on the side?
On the side,
yeah.
Okay.
With investment banking hours.
That's tough. That's
and
very
it ended
tough.
up taking me 9 months to quit.
Okay, amazing.
But I quit after 9 months, which was March 2023.
Okay, amazing. Yeah, special date, I'm sure.
Yeah, it was.
Yeah. And so when you made that leap, what skills from banking turned out to be extremely useful into what you were building, and which ones were maybe not so useful and you realize actually, they were overlooked or maybe not necessarily there?
Look, I think the discipline is important in banking. And also, you realize that if you have the ability to work 18-hour days, including weekends, and do a good job, have a good output, then why not do it for yourself?
Yeah.
So that discipline of working really hard is something that I got from banking. And client interaction, negotiations, looking at deals, it's all transferable skills to a certain extent. Now, do I think the modeling skills and the PowerPoint skills are as relevant? Probably not.
Yeah.
they're good to have,
Yeah.
but are they crucial to building a business? Probably not.
Yeah.
So, but I think the soft skills from banking are actually really good, and it applies to other corporate jobs. If you're in a high pressure environment, whether let's call it consulting, being a corporate lawyer, and other corporate jobs, the skills are transferable. The soft skills are definitely transferable.
Yeah, 100%. And so, in your own words, can you explain to our listeners what actually is Stryde?
Yeah.
And how the focus into sports came to be?
So Stryde is the first regulated digital platform enabling individuals and institutions to invest in privately held companies anywhere in the world. Our focus today is on sports and entertainment. So we allow people to invest in teams, leagues, tournaments, movies, gaming. We're also expanding, and we'll talk about that. We're expanding into what we call cultural assets, which is also collectibles, comic books, sports cards, rare sports cards, and another segment to creators. And that's a different thing, but we want to also expand into creator-backed ventures, but also turning creators into a business and buying equity in creators.
Okay, wow.
And we saw that with Kabi. Yesterday it was announced almost $1 billion was raised in that. And Mr. Beast did the same thing. Anyway, we'll get to that.
Another tangent.
So that's what Stryde is. People can come and invest from $1,000 or $5,000 or $10,000 and have exposure to an asset class they never had exposure to. And if we're talking about sports and entertainment, it's actually an asset class that's beating the market. So the returns of sports, if you look at NBA, NFL, Formula One, Premier League teams, valuations on paper are exceeding S&P 500 returns.
I saw that, and I want to talk about valuations, maybe as a next step, but just to stay still on your kind of trajectory. So as you say, it's like the first that exists, the type of platform you're creating. So you're early in this category, and that comes with both advantages and risk to be an early mover. What do you think was is the advantage to being an early mover in something? And what was the first thing maybe you did? Because as you're trying to build it, you need to have some education on the side as well. So how did you kind of navigate that?
So that's a disadvantage that people don't know about it. The education element. You have to educate people that this is an investable asset class, and you have to educate people that this is a platform that allows you to invest with smaller tickets. But the advantage is it's an exciting asset class. It's an exciting space. It's from a financial point of view, it's doing well and it's beating the market, but also it's passion investing. If today someone comes to a sports fan and tells them you can invest in a sports team or you can invest in a movie or in a show or anything within that ecosystem, it's exciting.
Yeah.
So the excitement of the asset class helps a lot. We're not digitizing manufacturing investment, which could be good, but still not as exciting. We're playing in a space that's about passion, that's about culture, that's about people, that's about fandom, and that helps a lot. And the other thing is I think we're in the right space at the right time, because sports as an asset class is just evolving now. And we're seeing a lot of movement. There's private equity funds, there's venture capital funds that are being raised specifically to invest in sports. And that's not something that was there 5 years ago. So I think the timing, the space itself, and the product that we built, the ability, the fact that we got regulated, and the fact that we built a product that's engaging, that's seamless, user experience is pretty good. I think the combination helps a lot.
Yeah, definitely. And on the point of being regulated, how did that journey kind of look like from when you had your 9 months where you started it and then you launched? But how was the journey in the background? Because I feel like a lot of people, will see the headline or see something that, oh, you founded this, you did that, you raised this much, but they don't really see what happens in the background.
So if I was to talk about regulations, we might need 2 or 3 or 4 episodes.
I don't want to talk about that.
Because it was a long process. It's obviously a painful process. It's a rewarding one. When I said 9 months, 9 months is when I quit my job. I didn't have a license. I didn't have a platform when I did that. All I had was a business plan and a pitch deck that I can hold and say, this is what we were doing. So we started understanding what licenses we need and which regulatory authority provides it. And turns out the license that we need is only provided by the FSA, which is the regulatory authority of the IFC in Dubai. And we decided to pursue that license. And we thought it's a 6 months process. Long story short, it ended up being an 18-month process.
Oh, okay.
But after 18 months, we became the first digital platform that's regulated to allow individuals to invest. And that opened up to retail investors. So anyone can complete the onboarding process and invest, obviously within certain requirements and regulations, but can invest in this asset. And we became the first in the Middle East to actually have a license like that. I believe till today, we're still the first platform that focuses on the equity investing piece and that can digitize it the same way we do. So yeah, long story short, it took us 18 months. It was a very, a very long process for a lean team startup with no capital. We don't have a legal structure behind us. You know, we didn't have an army of lawyers.
Yeah.
We had to do things ourselves. We had to draft policies and procedures ourselves.
Wow.
We had to see what works and what doesn't work and what makes sense on paper and what doesn't, and to speak with the regulators and to get feedback and to iterate. We had to do that ourselves.
Yeah.
But that's the beauty of, you know, starting a company at that stage, at that in that time.
Yeah, no, for sure. And I think, you know, it echoes a lot with other stories you hear, like, you know, when Kalshi was created, Coinbase, Robinhood, they all had this whole legal aspect that they needed to run through before the product could even exist. And so you're trying to build trust, you know, in a new financial category in some respect, where rules are still unclear and they're evolving as you build it. And so if you spent that much time, you know, in the regulatory work before things could really move and you were allowed to, you know, start on your idea, what do you think it takes mentally to get ready for this? And how did you kind of overcome this, you know, on a personal side?
Look, the thing about getting regulated is you don't know the exact timeline. If you think it's 6 months, it might end up being 12 months, it might end up being 18 months. But during those 18 months, you don't know when is that date. So the product was ready, the platform was ready. We wanted to launch, but we couldn't because we needed to wait for the license. And during that time, to be fair, it turned out to be good for one particular reason. Okay. During those 18 months, we were testing different asset classes and getting feedback on what people want. And during those 18 months is when we discovered sports as an asset class. Okay. So right before we got the license and got regulated, we were already evolving into a sports platform and we were getting access to sports deals. And I was understanding that this space just has a lot of potential and it's untapped. And that's why we ended up pivoting. So it has pros and cons. We needed to get creative. We needed to find a way to start. We needed to focus on user feedback. And we kept, you know, trying to go out to market without actually operating. Yeah. And it ended up helping us. But also, for a startup, you need revenues. You need to be able to generate some sort of financial returns. We had to be very lean. We had to manage carefully. Obviously, we put in our own capital. We had raised external capital, which also helped a lot. But yeah, we found a formula that just allowed us to go through until we launched.
Mm-hmm. Okay, interesting. So before we move into, you know, understanding the sports category and as an investment, if you look today at how you built, you know, Stryde, would you have done something differently?
Oof, that's a big question. Yes, if I do it again, absolutely.
Okay, really?
Because what you learn in the journey is something that you will take to your, you know, next venture and the one after and the one after. And I think it just it's experience. Yeah. Nothing can replace experience. Even if you're the smartest 25-year-old in the world, there's something about experience that also needs to be there. So absolutely, I would change a lot of things. Yeah. I wouldn't make the same mistakes. I wouldn't. I would avoid certain pitfalls that we had along the way. I would deal better with legal, with compliance, with understanding a bit more. But also, I would focus less on product, more on distribution, which is a sort of a cliche thing, but it's so true. We spent a lot of time designing the front end and the landing page, and it matters. The marginal return from it is not as big as the marginal return from distribution. Okay. So I would do a lot of things differently. Yeah,
I can see that.
But that's good. That's the learning, right? But yeah, would I want to go back and change anything? Absolutely not.
Yeah, no, definitely. And so just quickly from those, what are then, if I want to tell you to give some piece of advice for, you know, anyone listening that is trying to venture into that entrepreneurship route, based on everything, you know, you would do again, maybe what are things they should focus on, or what's one piece of advice?
I would give an advice that I didn't really do myself, but I would say surround yourself with a few very good advisors that have been through the journey, and trust their their opinion, and try to listen to them properly and actually benefit from that experience. And that's not something I did. I just wanted to listen to what I thought was
Yeah.
right, and I wanted to do the things that I thought were right, and that's how you make mistakes and you
Yeah.
learn from it. But I think if you surround yourselves with a few very good advisors that you trust and that you can look up to, it will help a lot.
Okay, great. Thank you for that. And so if we move to sports, as an investment, you've obviously said that it evolved into focusing on sports when you wanted to democratize private markets. Can you explain a bit like what kind of sports can someone, have access to, and how do you actually even get those deals?
So the first deal that we had on the platform was an English football team. So people were able to invest in an English football team. It was in the second division, and it's a very popular team. People know it. And from there, we just expanded into any sport, any team, any league, whether it's established, like Formula One, NBA, Premier League, La Liga, anything in football, or emerging, like paddle, like new formats of the same sports. In football, we've got something called Baller League and Kings League, and they're kind of reshaping how football is, not 90 minutes, not 11v11, more creator and streamer focused. So it's an interesting model, but there's new versions of existing sports, and there's also new sports. And it's across the spectrum. It's the deals that we think have a lot of potential. It's the deals, ideally for us, we're co-investing alongside one of the big funds so that we can also have that due diligence, credibility to rely on too. But it's anything within sports. And also we expanded that into entertainment. One of our largest deal was a game, actually.
Oh, really?
It was a game that's coming out in August on PlayStation and Xbox.
Okay, nice.
And we're also looking at movies, we're looking at shows. So it's expanding beyond sports too.
Okay.
And as I said, collectibles and creators,
Yeah.
but that's coming soon.
Okay, nice. So it's not really just the club or like it's everything that's related to it. So for example, obviously sports is, I think, one of the few activities or passion people have that are still, that you can experience live rather than just on screen. And so there's a lot of push from media, technology, and things you see around you, because you have all the ads over there, and you have, the shows that are moving into Netflix and everything. Is that something that you also would be investing in, or how do you get that exposure?
So you mentioned a few really interesting things.
Okay.
Here. I'm going to pick it apart.
Yeah, sure.
Maybe into 2-3 parts. But we're looking at a deal where we're going to get it on the platform and people will be able to invest in it. And it's the IP of legendary athletes. Okay. So people will be able to invest in the IP, and we will use that IP, or the company we're investing in will use that IP to monetize it. So Netflix shows, merch, movies, anything that can be built around it. And this is an opportunity we're about to present. But the one thing you mentioned that was really interesting is you said live experiences. Mm-hmm. And yeah, sports and entertainment is all about live experiences. People love live experiences. There's a lot of data and research in recent months about how the new luxury is actually premium experiences. It's not the bag and the watch and the car as much anymore. And it's about people just wanting to be in certain events, in certain locations, in certain places. And that's why our product that's coming out soon is Stryde Experiences.
Okay, nice.
So we're launching an experiences platform that allows people to also access those extremely curated experiences on the platform. And for example, World Cup final hospitality, Champions League final hospitality, Formula One paddock weekends, but also with an added element, meet the drivers, nice. Something extremely curated, extremely exclusive. And it ties into our product, which is more on the premium side of things. Because we're not a mass market platform. We don't have a minimum of $50 and $100. The average investment on our platform is $50,000. So it's quite on the higher end. And that's why we're rolling out an experiences product, and I'm quite excited for it.
Yeah, super exciting. I'm going to sign up, to be honest, because I just discovered about that. That's super cool. And so you mentioned, obviously, the average ticket is 50,000, but you can allow access to as low as, 5,000. If I come in as an investor on your platform with this 5,000, or even maybe, I don't know, less, how is that, significant enough to get me returns? Like, what should I expect if I tell you today, I want to invest in the deal you have with an F1 team, because that's the sport I love, and I just can put, 5K. How's that journey for me, and what should I expect?
Look, the return is on a percentage basis. So if you're looking to make, I don't know, 50 or 100% returns, doubling your money, $5,000 or $500,000 is up to you and what
Yeah.
you can what you can put in. But the return is on a percentage basis. So we want to make sure there are opportunities that are attractive enough, you're passionate about, and that have the potential to make those returns. Now, in terms of the journey, you go onto the platform, you sign up, we're regulated, so you have to go through KYC AML, which is a 2-minute digital process, very seamless. And then you can browse the deals. If there's a deal that you like, you end up investing in it, and then we manage that investment on your behalf. To exit, which is when you actually make your return and return your capital, there's multiple ways. And the main one is we're regulated to also offer secondaries on the platform. So we allow people to exit on the platform through our exit windows. So you can sell your share at the updated valuation to someone else who wants to buy your shares. And obviously the other ways is the team is sold or there is an IPO, which doesn't happen much in sports. But that's how you actually return your capital.
Okay. And what do you think is something important for an investor to know, because obviously we have different risk appetite, we have different investment horizon. What are questions we should be asking ourselves when we're looking at a sports company?
Look, at the end of the day, private markets is all about knowing that it's a locked investment. We try to facilitate secondaries and make it more liquid, but maybe in many cases it might be locked up for 3 years or 5 years. And you need to have that understanding of how private market works. Our audience is savvy enough to understand how these investments work, and is savvy enough to make a decision that, this is an investment we want to do or not. And our platform is full of disclaimers, disclosures, making sure that investors understand the risks of investing in an asset class like that. But it depends on the investment. If you're investing in an emerging league, it's more of a venture capital play. The league might work and it might do very well, but it might also go bust and go to zero.
Yeah.
If you're investing in an established team, then it's not going to go to zero because there's a lot of moving parts. There's a stadium, there's real estate, there's things tied to it. So it won't go to zero, but it might not return the capital. So it depends on the type of investment.
Okay. And when you mentioned the risk, the first one that comes to my mind is the liquidity risk, right, of maybe exiting. What are some other risks that come into play? Because obviously, it's private market. On the public side, you're faced with everything that's related to, macroeconomies, every events that happen that can move the stock market, for example. But here, because it's private and so not listed, what are some other risks in that space that you have to think about?
Operational risk is definitely one, and it's probably the main one. Okay. If you're investing in a team, not as the football team, a management team that has good capabilities to operate and execute, then you know that your money is in safe hands and your capital is being deployed and managed properly. And if we end up bringing a deal where the management team is a terrible management team, then the operational risk is obviously much higher. So that's what I would think of. And then in private markets in general, you have to weigh the risk-reward ratio. Is this a venture capital play that might make me 100x, and thus I would want to take more risk? Or is this a private equity play that might make me 20% annualized return, and I want to take less risk?
Yeah.
So it's also a risk-reward ratio question for the investor to make. Some people are more comfortable with riskier assets, riskier plays, riskier deals, and some people are just more risk-averse by nature and would rather something a bit safer.
Yeah. In terms of like the different categories of sports, are there some that you see as being, riskier or less risky, say if we compare football to paddle to NBA?
Absolutely. Anything that's emerging is riskier.
Yeah.
So if you're investing in an emerging paddle league, an emerging paddle venture, an emerging cricket venture, anything that's new is riskier. But within the established sports, anything that's US-based is actually less risky.
Okay.
Because the NBA, NHL, NFL, MLB, even MLS are very well managed. The American sports, the way they manage their teams and the growth of the franchise value is incredible. And no one can do that. And compare that to European football, you've got the top teams that keep growing in value, but you have so many teams for sale and so many teams transacting and so many teams losing money in European football. And if you look at France, for example, and the media rights problem, they lost the media rights and they had this issue with the zone for a while. But if you compare American sports to how European sports are being managed, there is a big gap.
Big gap, yeah. And so obviously, there are so many teams, so many sports, so many opportunities. On your side, how do you select the deals?
Yeah, look, we're not a volume-based platform. Our idea and the concept is not to bring in 20 deals at a time and just show everything. We're very curated. You might go on the platform and see only 2 deals at every point in time. We don't want to focus on just more deals. We want to focus on quality deals and the deals that we really believe in. So this is where you have to make a decision. Is this the right opportunity? Does it have the right backing? Do they have the right capital? Do they have the right potential? Do they have the right management? And is this a deal that we want to present? I mean, as long as it passes through all the criteria that we look for, it's a deal that will be on the platform. And if we have 2 or 3 deals at the same time, then the rest we're either not going to look at it if it's within that time frame or keep it for later. But we don't want to overwhelm investors or users with so many deals. And we don't want to be just a typical platform presenting a large number of deals and focusing less on quality, more on quantity.
Yeah, no, that makes sense. You're not really like doing crowdfunding
Absolutely
for a lot
not.
of deals. Yeah, no, that's very clear. And so what are some maybe non-negotiables when you're looking at those deals that you should, that you look at that would maybe kill it or make it, pass your checks?
The most important thing is who are the other investors.
Okay.
We want to know that we're co-investing or bringing a deal for the users to invest in alongside top investors, top private equity firms, top venture capital funds, and this gives the deal a lot of credibility. It gives the investor and us a lot of reassurance that they have the right. These funds spend 12 to 18 months doing due diligence.
Yeah.
They spend so much time and a lot of resources and research and meetings and doing everything that needs to be done to put the capital in those deals. And we know these funds, and not every fund is as diligent, but we know the ones that are, and we try to bring in deals alongside them. That's as one criteria, or the main one, I would say. Other than that, it has to have a good return potential. Some deals, and that could be European football, if you bring a football team, it could be a nice deal, and investors might like it, but we don't believe that it will make that return potential, or it will have that IRR that we think is aligned with how we're looking at deals. So we wouldn't do it.
Okay.
So these are the 2 main things.
Okay. And when you talk about the return, obviously, if you throw me a number now, I can't really assess whether it's high or low because a number by itself doesn't mean anything. What is the average maybe return in a sports team or in some of the deals you make that, I can be like, okay, that's good enough?
Risk reward, I would say first. Okay. Before we talk about the number, the return number, it's about how much risk are we taking.
Yeah.
If we're investing in a very safe asset, such as an NBA team or a Formula One team, we'd be happy with 15, 20% annualized. Maybe they make more, and they have made more.
Mm-hmm.
But this is a very good number to settle on, 15, 20%, less risky than other assets. If we're investing in a new paddle league somewhere in Southeast Asia, where it's extremely risky, but it has so much potential, then we definitely wanted to do at least 5x.
Okay.
So it's a risk-reward ratio.
No, that makes sense. I'm just trying to think as well, if someone obviously is investing in this as part of a bigger portfolio they have, how does that fit? How does that, help? And so if we talk about it from maybe a diversification perspective, do you think it helps to invest in, does it make sense to invest in 2 different sports teams? Is there any correlation between anything that someone would maybe have typically in their portfolio and then within 2 different sports teams?
Look, sports in general is not correlated to the market. And that's something that's a fact. We've seen that it has no correlation to the market. To your point, we managed to get a lot of interest from family offices and funds that are keen to also invest in sports and entertainment through the platform. And we started by focusing more on individuals, but again, we realized very quickly that even bigger capital does not have access to this asset class. And that's why we became an individual and institutional platform. So we have both sides of the user or the investor base investing on the platform. And the idea is always to diversify your portfolio. I would say sports and entertainment, culture, whatever you want to call it, must be in every single investment portfolio. If you see sovereign wealth funds here, they're very bullish on sports and entertainment. They're investing so much into that. Obviously, it has additional value. But if you want to build a uncorrelated portfolio and a very diverse portfolio, sports and entertainment must be in that portfolio.
Mm-hmm. Okay, amazing. Yeah, I tend to agree with that. And so if we look at an investment deal, like a deal that you have, what kind of generates the value in that deal? If, for example, I don't know, does it impact if, say, I take a football team and you have players that keep on moving, doesn't that make your investment a bit more, like fluctuating in value? Or, I don't know, if the day you'd launch a Netflix deal, then that increases the value. How do you look at that?
There's a lot of moving parts,
Yeah.
and it's part of the growth that we look at. These things are in the pipeline. If we're looking at a team in France in the second division that has a star player they will sell in the summer, then there's some sort of income coming from that. If we're looking at a team that's doing a Netflix show and we know that's going out to the market in a year, then you also factor that in. But in general, it's the team's job to figure out these opportunities. Some teams rely more on player trading, develop a player in their academy and then sell them for a big transfer fee to bigger teams. Some teams are very creative and innovative in the way they generate their revenues. One example is Wrexham, where Ryan Reynolds is now an owner. They've done really well in just monetizing across the spectrum. They're obviously not focused on player trading. They're not developing players and selling them. But they've done a Netflix show. They've built an incredible IP. Obviously, Ryan Reynolds' presence helps a lot. But it depends on the team. And that's also part of the strategy and part of what we look for to understand more about the opportunity and how this can grow.
Okay, that makes sense. And so just bringing it back away from all of we've discussed for a bit and coming back to your own journey of, when you did Stryde, how was the education process taking place on your end? Because for someone who first doesn't know maybe too much about sport or knows a lot about sports, but not about investing and looking at that, how do you go about educating people?
There is two sides to that question. One is we weren't focusing on the masses. So we didn't have a mandate to educate everyone to understand what we're doing. We never wanted to have hundreds of thousands of people on the platform. We wanted to have a tightly knit group of users that are on that same wavelength, that understand how the platform works and understand the asset class. So even though if you want to scale it and grow it and take it to everyone, you have to focus on education. That was not our focus. This is a challenge and something that we want to do down the line, but it was not the focus to educate everyone. Now, to talk about that group that we had, it actually worked very organically, and we don't spend money on marketing. We're not a platform that has a high customer acquisition cost. In fact, we have no customer acquisition cost because it's not part of how we're building it, especially in those early days. And organic effects, network effects, it was, people speaking to people. If one person understands it, they speak to their group of friends. Their group of friends now understand. So it was actually network education more than us educating. And the thing that really helped, in the early days, we spoke to a lot of users. So if you come onto the platform and you spend time, I would give you a phone call and I would ask you for feedback on the platform.
Okay.
And that helped a lot because then we realized what we need to improve in the product so that the product educates you enough.
Okay.
So now we have some gamified features about the returns, your investment, the fees, what you're investing in. And we just tried to answer all of the pain points that users had. And I think we did a good job. Obviously, the platform is not perfect and it will always need improvements. But that user feedback in the early days was very good for us to understand what's missing. Because for me, obviously, everything was perfect from day one. And it never is. It was very far from perfect.
Yeah.
So it helped a lot to get user feedback, proper user feedback, and from the ideal user. Because we did not just go about growing and acquiring any user, we got very detailed feedback that's also very relevant to us.
Yeah.
And we grew it from there.
Okay. What is one common feedback that you received from everyone?
I have a few. A few of them were saying, we don't even know what we're investing in. It's like, is this equity? Is this debt?
Yeah.
What is this deal? Other main feedbacks were, what's the minimum? It wasn't clear.
Okay.
$1,000, $10,000,
Okay.
$500. And some of them weren't understanding the fees. And that's why we built a gamified simulator depending on the amount and the returns, because some of our fees are tied to your return in a form of carry. We build a gamified product that just shows you, based on your amount and your return, how much the fees actually are.
Okay.
So these were three main points. These are the ones I can remember.
Okay. Yeah, I think it's funny because sometimes when you're building something or you're so ingrained in a job, you think people will understand it very quickly because for you it's like second nature, the things you're discussing. And then when someone comes from the outside and points out something, you're like, oh, okay, isn't that obvious?
It's a bias. For me, I'm
Yeah.
like, the platform is perfect. What are you talking about?
Yeah, I'm pretty sure you thought that. And so maybe then as a kind of, to wrap things up a bit, obviously, you had this whole journey and, you built something and you broke free from, I would say, the corporate life to entrepreneurship. Is this, do you think, the right path for kind of anyone that has that entrepreneurial itch to do you think they should, do it when the time is right, or they should wait it out a bit, or, you started, there are different ways to do things, right? You had zero acquisition costs, so everything is word of mouth, but you also had your user giving you feedback. So in a way, you weren't really ready with the product, right? You had to kind of work along to get to there. How would you advise someone to start if they maybe have just the idea and then they want to take one step?
Look, I think every journey is very different. And I don't think there is a right time. If I go back and look at the facts, I think it was definitely the wrong time for me. Like I took such big risk with doing this that if anyone knows how this came about, it just doesn't make any sense.
Okay.
So I'm not sure if someone else figures out a perfect right time to do things, but I just don't believe in a right time. If you keep waiting, you will keep on waiting.
Mm-hmm.
Now, in terms of what I would advise someone to do, or if it's for everyone, it depends if you can handle the risk, the stress, the potential of failure. It's so many things, and again, there's a lot about that. Some of it is cliche, but I don't think entrepreneurship is for everyone, and I don't think everyone should do it the same way. And some people get luckier than others. Some people might end up building an insane product and get $100 million. Not doesn't happen a lot, but get $100 million from day one, and you can start building and all this. But if you're talking about the average journey, I think you need to have it in you. You need to have enough conviction in what you're doing, enough conviction in yourself, because there's ups and downs every day, and there are so many downs.
Yeah.
It's genuinely, there are so many downs that if you don't pick yourself up and if you don't believe in yourself, you will give up and you will fail. Failure is fine, but you will fail because of the lack of confidence, not because of the business not working properly.
Yeah. No,
so I think if you have enough conviction, and if you feel that you're built to just handle that ridiculous stress and the ridiculous risk, then it's for you.
Yeah, I think you need a lot of stamina and discipline
Absolutely.
to get yourself back up. So how in those downturn, how did you kind of stay grounded and pick yourself up?
I mean, look, I had no choice. That's one. And two is I have a lot of belief in my idea and in myself. Like I always knew whatever happens, I'll figure it out. And look, as we went, the downside became higher and higher. Like today, if everything goes bust, we will land at a good place, to a certain extent. In day one, if it goes bust, then we're back to square zero and back to square -10 maybe. So I had a lot of faith in what we were doing and in myself, but you also have to a certain extent you just have to keep going.
Yeah.
And if you look back at 6 months ago, you realize, how did I do that? And you have no clue.
Yeah.
You just kept going, and things happened.
Things happened, yeah, definitely. And so maybe one last question to close this off. If there's one lesson you have from building Stryde that you can tell us that taught yourself something that banking never could, what would that be?
Everything is about sales.
Okay.
Everything is about distribution.
Yeah.
You'll never learn that in a corporate job, but everything is about proper distribution channels.
Yeah, I think that's totally true. I think any role or whether you're building something, whether you're working on something for yourself even, or you're trying to put yourself out there, it's all about the perception you give and the sales and how you tell that story. And
absolutely.
Yeah, because I think a lot of times sales is overlooked as a job, but it's so key because you can have the best product but don't know how to deliver that to the audience.
And this is why so many funds these days, they don't invest in just purely technical, let's say founders or a brilliant technical product. Because the technical product on its own without someone putting it out in the market is pretty useless.
Yes.
So a lot of the funds I know are looking for that combination of, yes, a good product, a good technical element, but also very good capable distribution.
Mm-hmm. Yeah, you need a good storytelling as well.
Yes.
Yeah, perfect. Well, Hadi, thank you so much for your time. It was great.
It was really good to be here.
Yeah, it was great to have you and to discover all about this. And for our listeners who are interested, I'll put in the show notes the link for Stryde if anyone wants to check that out. And thank you so much.
Thank you very much.
You've been listening to The Seat of the Muse, and I'm so grateful you chose to spend this time with me. If something stirred you today, a thought, a feeling, a question, I'd love for you to subscribe and follow on your favorite platform, leave a review, and even share this episode with a friend. Your support truly fuels this space and helps invite more voices to sit down with me. Until next time, stay curious.